In 2017, tech stocks were a fan favorite as some finished the year posting triple-digit gains. But so far, 2018 has been a different story. February has hit the market hard, including FANG stocks, which reportedly lost over $90 billion in just one day. Joining us to discuss whether the current sell-off in tech is a threat or an opportunity is Jim Kelleher from Argos Research in New York. Thanks very much for being here, Jim.
Thanks for having us today.
So I have to ask you, Jim, with the current sell-off in the market and tech stocks have been hit pretty hard, does this change your outlook at all?
Well, it certainly gives you some caution about the market overall, but it hasn't really changed any of the operating fundamentals in the technology space. So to recast what happened in 2017, we saw the tech sector up about 40%, or about 20% more than the overall market. And what's really gone on, in our view, is that technology companies have gone from selling products to other technology companies because of disruptions such as cloud and particularly the Internet of Things. Technology is now being sold to industrial companies, consumer companies, media companies. So the whole world is engaged in a digital transformation that is making the technology sector bigger, making it a larger weight within major composite indexes such as the S&P 500.
Jim, the first thing you touched on that I want to highlight is the 2017 performance. Do you see in 2018 tech being another big driver in the market?
Just before the sell-off really got going, technology was having a good year and was slightly ahead of the market, but it was actually about the fourth best sector. Consumer discretionary has been the leading sector, and other sectors had done a little better. In the selling, some high-profile technology names have been hit very hard, certainly as you mentioned, the FANG stocks. But other more mainstream and legacy technology companies have been hit a little bit less. And actually, we're seeing a lot of the selling focused in supposed wealth in the ground, inflation beneficiary sectors such as energy and materials. So technology has been kind of middle of the pack so far this year and middle of the pack in terms of the sell-off. So I think there's a recognition that you need to sell some of these names just to raise funds and to reduce exposure, but there's nothing particularly indicative of deterioration in operating fundamentals and technology that would cause a level of concern about technology that is in excess of your concern for the market overall.
I want to ask you, in terms of, deciding which stocks to sell and take profits versus, which ones are potentially a good buying opportunity, how do you make that call?
Well, what you normally would do, like if you have a rising market as you had in 2017, you have to try to think about how individual investors and how institutional investors also buy. What they tend to do is they buy the best growth names, and then as the year winds along, you're looking for additional opportunities. So we get that phenomenon known as a rising tide lifting all boats. So maybe some companies with more suspect fundamentals get carried along on that rising tide. Those aren't necessarily the first companies that sell off. So when the market is selling, you want to really try to get rid of the names that you think are less seaworthy as the seas, so to speak, get choppier. And in that regard, you're going to focus on positive fundamentals more so than you might have in a broadly rising market in which there was very little fear and a lot of complacency. Now that the fear is intense, you want to make sure you own the best performing assets. The selling we've seen now is occurring amid very strong earnings fundamentals for companies across the S&P 500, but even more so for technology companies. I think the selling has probably been triggered by fear that the Fed is going to be more aggressive and rising interest rates are a sign that inflation could be a problem down the road. But for the technology companies with their low debt loads, with strong underlying demand and these transformations we're speaking of, there's no reason to assume that slightly higher interest rates are going to, erode their operating outlook. So, if anything, if we go into kind of a low-grade selling mode here in the market as opposed to the panic selling, technology could reemerge as a favored sector.
So, Jim, I'm going to have to try to summarize everything you just covered there. So you don't see a fundamental shift, or you don't think in 2018 it's the time to panic for investors. You think fundamentally the economy is still doing pretty well. The sell-off hasn't been for a reason like the financial crisis. And you mentioned earlier disruption in the space. Now, I know in your report you cover things like AI, the Internet of Things, and even the cloud. Which one do you see as being the most fundamental?
Right, Sarah. Well, I would say that I think the cloud is the most fundamental disruptor because the cloud really represents treating computing as if it were a utility. It's more effectively done.
Now, I know you're pretty optimistic about the sector, the tech sector as a whole, but if you had to talk to us about one of the names you're most excited about, which one would it be?
Sarah, I think I would talk about Nvidia. They've gone from just being a graphics processing company to what they call a GPU compute company. So the way they're really impacting the world is, yes, their gaming business continues to go great guns, particularly in this realm of esports. But more important, in the cloud data center, we're seeing growth of over 100% any quarter.
And Jim, in terms of some of the potential risks for this name, what are you watching?
If a bigger company with AI goals such as Alphabet, Google, were to go down that path and that technology proved more successful than the technology Nvidia is pursuing, there are lots of rival strategies and technologies in the driverless vehicle space also. More broadly, the risk for technology in general is that it's discretionary spending. It's not essential, like turning on the lights or food or water. So it can be cut back in times of economic distress. But we don't see a period of economic stress. We see very little recession risk here, and technology is delivering such meaningful transformation that we think the spending there will remain robust.
Jim, thanks very much for joining us via Skype in New York. We look forward to having you again soon.